All right, everyone, this is Matt and Ken from Mission Financial Planners. We're going to talk about getting long-term care planning right today. Before we get into our big introduction and all that, though, first of all, I want to say happy holidays to everyone. We're recording on today is December 21st. We had some technical issues. Our internet got turned off this morning because of some work going on in the suite next door to us. So this is take two today. So we like sharing that kind of stuff with people too, because you see the business side of us a lot, but you don't always see the what has to happen behind the scenes too. So we're going to start off. Ken's going to have a little bit of a quiz. We'll just remind you again on who Mission Financial Planners is and who we are. We'll jump into long-term care. It should be 45 minutes tops. So Ken, go ahead.
Perfect. Thank you, Matt. So everybody, what a great way to run into the holidays with a pop quiz. So what we're trying to do is match the percentage with the right statement. So the first statement is what percent of Americans over 65 are going to need long-term care? Is it only 3%, 8%, or 70% of Americans will need long-term care? Option B, percent of Americans who think it's very likely they're going to need long-term care at some point. And then option C, what is the percent of Americans that have put a plan in place? So take a quick second and think about what the right answer is. So diving right in, 70% of Americans are going to need some kind of long-term care or assistance. We do this workshop a lot. Typically, it's in a room of 50 or so people. And what we like to do at this part is have 50 people stand up. We count off 15 of them, have them sit down, and then explain that everybody that is standing is at one point going to need long-term care assistance and help. Now think about that. If you're married, statistically, you or your partner are going to need it. And what makes this difficult, and Matt's going to elaborate this on a little bit more, is the baby boomer generation is living longer than any other generation before. The illnesses and ailments that used to end life, like strokes, heart attacks, and different forms of cancer, typically just means that there's additional care, and actually, longevity increases, which only increases the chance that you're going to need it. And so 70% is likely going to. Now, with that being said, that only 8% of the people in that room believe that they are very likely to need it, when statistically that's not the case. So why is there this dissonance? And I think part of it is just your generation is experiencing something that has never been witnessed before. And the last thing I'll point out is that only a handful, less than 3% of Americans have a defined plan in place. Now, that's what we're going to be beating a lot, is having a plan. And I'll be talking about in my breakout session what that might be able to look like. Matt, anything you'd like to add?
No, it's always amazing to me, right? I mean, it's something you should plan for, right? And a lot of people just don't do it for whatever reason. So, okay, long-term care plan. Before I get into the presentation, I am going to share my screen here quick. I want to show everybody something real quick. So screen, and there we go, share. Okay, so what you'll see here is I've done a Google search for something called certification for long-term care. This is the credential I hold in long-term care planning. Okay, the reason I got this credential is because, or versus some of the other long-term care credentials that are out there, this is the only long-term care credential that is not actually fully sponsored by an insurance company. So as a certified financial planner, I take that very seriously because we have a fiduciary responsibility to our clients. Well, if my training is from an insurance company, how can I possibly really say I'm a fiduciary at that point, right? So at any rate, this isn't just for people who do this kind of work. If you go to their website, which is just ltc-cltc.com, and you click on for the public, what you will see is they have a ton of great information that's available for you to peruse at will. So you've got an overview on what is long-term care. It gets into more definitions of it, cost of care, how and where you're going to get the care, funding options, even how would you submit a claim once something does happen. So it's a ton of great public information. They've got this stuff available for you. You can download it, stick it in your important file, right? Whatever. right? But this website again is just, if you just Google certification for long-term care, that's the group I went through my training on with long-term care. And again, they're not owned or sponsored directly by any insurance companies, and that has a lot to do with why I started working with them. But lots of great content there for you, to be able to really help you make a good informed decision. All right, let me jump back to the presentation here. Okay, that good informed decision, that's why we do these webinars. And I know it's a YouTube video, but this is a, we do this in a webinar format. We do this in an in-person format. And we totally believe as a organization that if we educate you and help you make good informed financial decisions, you'll want to work with us, right? And that's why we do this, right? We want to help you make good informed decisions. A, you'll be more confident. B, you'll want to work with us to help you implement those decisions. I mentioned we're fiduciaries, as being certified financial planner practitioners, right? One of the responsibilities of a fiduciary is to also recognize when something is a little outside of their scope of expertise. And so you'll see here, well, we're in the trenches with you every day working on, hey, this financial plan, this healthcare plan, this retirement plan, this tax plan, this estate plan, all these different planning areas. Well, guess what? We may have to pull in a tax expert or a trust expert or an estate planning expert or some kind of finance expert who's outside of our scope. That's what we have all these partnerships for, right? And I always try to remind people, look, it's just like going to your doctor. Your doctor most likely is a general practitioner, and that doctor is going to be like, oh, wow, your foot looks really messed up. Here's a podiatrist you should go talk to. Your doctor is acknowledging, yeah, I see a problem here that needs to be addressed, but here's the person you should be working with to seriously address it. So think of us that way. Think of us that way when you're working with us. The other thing, we are in 28 states. We have no problem working with you regardless of what state you're in. We may need to contact the state to get licensed in the state, which is a pretty easy process, generally speaking. But if you're in Idaho watching this, Hawaii, Alaska, wherever in the United States, and you want to talk to us, let us know. You can always give us a call toll free at 888-339-0093. Once again, 888-339-0093. You can email us at admin@mfplanners.com. MF stands for Mission Financial, not what you probably think it stands for. But admin, short for administrative, right? ADMIN @mfplanners.com. Now, the way we work with people, and I mentioned some of the different planning areas, right? Retirement income plans, healthcare plans, long-term or tax plans, estate plans, investment plans, right? There's all these different planning areas. We always follow a process. The process we follow is really straightforward. It's the financial planning process is defined by the CFP board. And it's essentially, any of you who've worked in professions or trades, you guys follow processes all the time too. It's no different than a lot of your processes, right? Understand the goal or the problem, right? Get to know you as the client. How do you want to get there, right? What's comfortable for you, right? Analyze what you've already done, put together some recommendations, talk through what sounds best, implement, and then monitor, right? And monitoring is probably the most important part of this, because what happens with monitoring is 10 years from now, who knows what's going to change in your life? Who knows what's going to change in the economy, in the market, right? Nobody knows. 20 years, 30 years from now, again, nobody knows, right? So from that perspective, monitoring, in my opinion, is the most important, because it gives us a chance to modify the plan as needed. And that's the plan that's going to work. 3 managing members at Mission Financial Planners, left to right. Jason Defoe, he is in charge of advanced planning with Mission Financial Planners. Ken in the middle, me on the right, more focused on retirement income planning, healthcare planning, tax planning. We do some estate planning, but Jason really is the guy that you're going to work with if you have some more complex issues you're dealing with. We do not give tax or legal advice. We can help you with tax or legal planning, but we're not attorneys, so we cannot practice law. We're not CPAs. We cannot give tax advice. We can work with your CPA to make sure your CPA understands what we're recommending. And I've never had a CPA come back to me and say, that's a bad idea, you shouldn't do it. So, this is who we are as a team. Now, retirement itself, retirement readiness, right? Healthcare is a huge part of this. I'm not going to take you through the whole thing, but if you look at, you're going to retire, you have cash flow, investments, right? I got to make sure I still get paid in retirement, right? Social security, pension, investments. Where's all that going to come from, right? Then we get into the healthcare side of things, right? And healthcare, by the way, can include insurance. What I would recommend for all of you who have some kind of term insurance or even a permanent insurance policy, keep it as long as you can. You don't know what's going to happen to you, to your spouse. Sometimes those policies have benefits in them that can be lifesavers when something does happen. And you might just not be aware that it's there. Okay. So even if you have a life insurance policy only, I strongly recommend you keep it as long as you can. Medicare and long-term care, we'll touch on this today. Folks, Medicare does not cover long-term care in any way. And if you check out our 30 minutes on Medicare basics webinar, and we have a couple others that are in development that are more advanced, we talk about that in those webinars very extensively. Okay. Long-term care planning, focus of today. And then, of course, tax and estate planning. A thing about tax planning, you could draw a line right from there straight across to investments. A lot of people have the wrong focus when it comes to their investments. They don't look at real return. They look at either investment return or total return. Real return is what you keep after taxes, fees, and expenses. Okay. Your real return is the number you should be focused on. And what I've seen across our industry is a lot of advisors do not focus on real return. They just focus on, hey, my portfolio got you 12%. Well, that's great. But if I lost 42%, 48% combined state and federal income taxes, I didn't get 12%. I got closer to 6. 12% looks good on a sheet of paper, but come tax time, 12% is not what the number is. Okay. Estate planning, we have a terrific relationship with an organization called Integrated Trust Systems. They can work in every state. Okay. And they use Nevada probate law for setting up estate plans for people. And check out our video on the last estate plan you'll ever need. We get into some detail on that for you as well. Okay. What's the issue with long-term care? It's confusing, right? And a lot of people just, it's not real. It's not for me. Ken talked about that in the introduction. The reality is it is real. Okay. Ken talked a lot about why people don't plan for this. Let me just focus on 2 key things that I haven't spoken about yet. We'll get into the Medicare, Medicaid thing in a minute. My family will take care of me. And do I really need it? Okay. 7 out of 10 people are going to need this. Okay. That's just numbers, right? That's just numbers. So a prudent person would plan for it. Okay. The second thing, my family will take care of me. That's probably the number one thing we hear from people is, oh, my kids are going to do it. My spouse will take care of it. I'm going to challenge you on that on two fronts. Okay. First, and this is a true story from about 3 or 4 years ago now. Sitting in with a wonderful couple, we're talking about putting together a long-term care plan. And by the way, a long-term care plan does not mean that you buy a long-term care insurance policy. It means that you've got a plan to deal with the issue if and when it occurs. Okay. But their long-term care plan was that their stepdaughter was going to take care of them. And I started asking questions about that. Okay. What does your stepdaughter do? She's a nurse. Oh, okay. Is that why is that why she said she'd do it? Well, yeah. And right there, I knew something was wrong because they kind of went, well, yeah. Then I asked, well, how much does she make as a nurse? And they said, well, we think about 100,000. Okay. So if something happens to one or both of you, she's supposed to full-time take care of you. What does that mean for her family, giving up that $100,000 a year paycheck? And you could tell right there they hadn't thought about it. And as I asked a couple more questions, it became obvious they had never talked to her about it either. They just assumed she would do it. There are a host of issues with expecting a family member to do this for you. And it's not that they don't love you. It's not that they won't do it. They will. They will kill themselves. And folks, there is data. There are surveys on this that actually show when you leave long-term care planning to your spouse or a child, that person has a significantly higher chance of dying before you do because of the stress it puts on them trying to take care of you. Okay, so don't put this on a family member. I'm not saying a family member can't manage your plan. That's very different than saying they have to actually provide the care. Couple other issues: emotional. If you do have one child who ends up taking care of you, that child will, in a lot of cases, end up really resenting the other children. And the reason why is it was all on them, and they will take that to their grave. And you'll have been the person who created that. So you don't want to put it on them. I mentioned the financial, and then the last point I'll make about this: if you guys think you're going to do it for each other, okay, if you're 55 and 57 today, can you lift your spouse out of bed, on and off a toilet, in and out of a tub or a shower, help them get dressed, dress them for them, right? Can you physically do that for your spouse today at 55 and 57? You're probably saying, yeah, I can. Or maybe you're not. Okay. Will you be able to do it when you're 85 and your spouse is 87? That's the point, folks. Yeah, we can do it. Yeah, we can do it. Yeah, we can do it. Oh, no, now we can't. What are we going to do? Unfortunately, a lot of people approach this that way. So a couple keys to really understanding long-term care planning. First thing is, long-term care planning is a range of services. It is not just shoving someone into a nursing home and forgetting about them. Second thing, Medicare and Medicaid are not a plan. And I'll talk about why Medicaid, even though it offers services, I'll talk about why it is not a plan. It is means tested, which means you have to basically prove you have no money to qualify for Medicaid. When long-term care first came out, your parents, your grandparents have probably bought some of these policies way back in the 60s, 70s, and 80s when this stuff first came out, and they probably had some issues with it, right? Since then, long-term care has been standardized, right? There are very clear triggers for when the policy works. There are lots of different types of policies. You may not even need a policy. You might just need to create an investment account that's just in reserve to help you offset some of the costs for this, right? But long-term care insurance is not what it was 25, 30, 40 years ago. And then new approaches, that some of the options I was talking about, we'll touch on those today. Okay, but this is probably the thing I hear the most from people, which is, I just don't want to end up in a nursing home. I don't care. I want to stay home if at all possible. Long-term care, most people, I should say, are going to receive their long-term care at home. So what is long-term care? Now, if you go read this, you'll see other definitions of this. There's chronic care, there's extended care. Long-term care is chronic or extended care. It's basically that there are 6 activities of daily living. Those 6 activities of daily living, the way the insurance policies at least work today, is if you cannot do 2 of those, it doesn't matter which 2, if you cannot do 2 of those, you're now eligible to start using your long-term care benefits. Here's the 6. You can see them on the screen in front of you. What I want you to focus on as you're looking at the list is, okay, when I get up in the morning, I get out of bed, that's transferring. Then I go to the bathroom, that's toileting. Then I might take a shower, right? Depending on how your morning goes. Okay, bathing. Then I get dressed. Then I go eat some breakfast. Guys, in the first hour of your day, you've probably done 5 of the 6 activities of daily living. If you just can't do 2 of those, you can use your long-term care policy to get some help, to get someone who can help you do that. That last one, hands-on versus standby care, right? The bigger point there is long-term care is with extended care, right? Chronic care, which is the definition of this. Long-term care is most of the time going to be hands-on, most of the time. Okay, there is a different trigger as well. So an additional trigger, and that's cognitive impairment. So if let's say you're dealing with dementia. I have an aunt dealing with dementia, right? And she's only 64, I think. But when you have dementia, this is an issue, right? All by itself, dementia could become a trigger because you probably need constant supervision at that point. So where do people get the care? I'll touch on each of these in a little bit of detail. At-home care, community-based care, independent living, assisted living, and then nursing homes. And then the cost. Okay, so this number tends to fluctuate on the left here, this number of 300,000. That's your average healthcare cost for a married couple over the course of retirement. That does not include long-term care. If a long-term care incident occurs, again, depending on where you live, the average cost per year is going to range anywhere from $60,000 to $110,000 a year. The coasts are going to be more expensive than the middle of the country generally, right? Large urban areas going to be more expensive than rural areas, right? What is it in your area? Hey, you saw that there's a cost of care thing at the CLTC website. An insurance company called Genworth, they have a great cost of care calculator as well. You just type in your town, it'll tell you, right? Just a point on definitions though. Median. What does median mean? It's the middle, right? The median care is 59,000, right, on the low end, 108,000 on the high end. That's in the middle. That means there are significantly more expensive options. There may be some cheaper options as well. Okay, but it's not inexpensive. All right, let's talk about Medicare or Medicaid paying the bills. Medicare and Medicaid are not an option. Okay. First off, Medicare does not pay for long-term care, and Ken's going to talk about that, but it pays for skilled nursing care, which is care you're expected to recover from, and it will pay for that for up to 90 days. There's a Medicare supplement you can get, which provides another 90 days of coverage on that. That's 180 days. Unfortunately, many people think that 180 days is long-term care. It isn't. You do not, and I'll just say it as clearly as I can, through Medicare, you will not be able to get long-term care coverage. The 90 to 180 day window that you sign up for, depending on your Medicare and your Medicare supplement, that is for acute care only. That is not extended care. That is not chronic care. Medicaid covers long-term care for eligible adults. However, one of the surprises on Medicare is you have to use up your assets and have extremely limited income, which means you don't have any assets, essentially. There's a look-back period. The look-back period is 5 years. And the way that works is if you give away all your money and then something happens where you need Medicaid, they're going to say, okay, well, you gave away $1 million within the last 5 years, and you're telling me that the cost of care at the location that you want to do is $10,000 a month. Okay, well, before you qualify for Medicare, you have to spend $10,000 a month until you've spent $1 million, which means 100 months before you're going to qualify for Medicaid. That's the way it works, folks. So you're not going to get past that, right? You're just not going to get past it. No room at the inn. You're going to go to where they have a bed. You're not going to go to the place you want to go. All right. So hopefully I've made that clear. Just in case I haven't, Ken's going to talk about a comprehensive healthcare plan and what that can really mean to you.
Perfect. Thank you, Matt. I'm going to be echoing some of the points that Matt has already been sharing and discussing, but I just want to dig a little bit deeper. And the thesis of my conversation is really, if not now, when? And what does a plan really need to look like? And I'd say the most common misconception we deal with and that we help clients work through over the weeks, months, and even years to implement said plan is it's not a silver bullet. It's not always just one thing that you do to cover you, your partner, as well as protecting your kids and that quality. It's might be a combination of the two, but it's bold, underlined, italicized plan. What have you done to make sure to know what your process is going to be? So we just covered this. How you can pay for some of these expenses. One of them is through Medicaid versus Medicare. Medicare doesn't cover it. And in order for Medicaid, there are income thresholds. There's a look back period that you have to impoverish yourself basically to qualify. And then also there are other things out of your control. What if there aren't any beds available? I mentioned 70% of the baby boomer generation is going to need this care at some point. Let's look forward 20 years. Are there going to be enough Medicaid funded beds if that is your plan? I don't know. Is that going to be around the corner? Is it going to be on the other side of town? Is it going to be on the other side of the estate, on the other side of the state? We don't know. But at the end of the day, you've worked long, hard, and I believe you deserve the quality care that you should have. Another option is self-funding long-term care, and it's popular. But what we need to do is make sure that we know what dollar amount or percentage of your assets are carved off to do just that. Because one of the things we don't know is with Alzheimer's on the rise, we don't know how long you're ultimately going to live. And right now, with individuals dealing with Alzheimer's or dementia, their life expectancy is closer to 8 to 10 years, and their care is a little bit more expensive, especially in those later years. And what are we going to do to take care of that? Now, some other solutions is using your IRA assets. One, when you have those major medical expenses, those are when they are above 7% of your gross income, they are deductible. So yes, you might have a $50,000 or $100,000 bill for medical expenses and care. You're going to be able to deduct most of those, so it's not shouldn't have major consequences overall. But what clients also like to do is use those IRAs. Maybe they have RMDs they're not using or planning on needing. Let's use quarters and turn them into dollars. Take your RMDs that you have to take and then have up to a 25% penalty if you don't take them. You don't want it, you don't need it. Maybe that's your situation. You take that and you fund a small or maybe a full long-term care plan. Another option is look at your tax advantaged resources, such as Roth IRAs. As Matt mentioned, we're in the holiday season. Right now is a very popular time to be doing Roth conversions. You know how much money you've made throughout the year. Okay, well, the 24% tax bracket for a married couple goes all the way above $350,000 this year. I only reported $200,000 of income. This might be a great opportunity to pivot $100,000, $150,000 out of your tax deferred accounts into an after tax account. Now, this is something you'll want to talk about with your tax professional or your financial advisor about to make sure it's done appropriately and not tripping any other wires, but it might be something to consider. Also thing is HSAs are a lot more in vogue and offered more and more, and you might be in a high deductible plan. HSAs can be a great way to fund either your long-term care costs, but can also be used to fund your long-term care insurance. The last thing I'll hit on, and most Americans that are homeowners have benefited from this, is a large increase in the equity of their home because mortgage values have increased. The problem is yes, my home went from 200 to now it's worth 400. My home was worth 500, now it's worth $1 million. Great, Ken, but I can't access it. Well, again, this may or may not work for you, but there are different tools and strategies, everything from reverse mortgages to home equity line of credit, where on that $1 million equity, you can access, I believe it's up to 80 or not 90%, 80% of the home equity. So 800,000 to cover those expenses. Now, maybe you want to leave your home to kids or you have different intentions for your homestead. Great. This may not be the perfect plan for you, but it's something to consider. So I'll summarize in saying there are multiple ways to take care of your long-term care needs. The thing is when are you going to put your plan in place? And the average household is going to be in long-term care between 24 and 36 months, depending on your gender and ailment. And we also know the average cost depending on where you live. So, okay, you have a $400,000 projected need for long-term care. You don't have to plan for all 400. Now, if you want to protect yourself as best as possible, sure, get as close to that. But just start. Get position 200,000 of your assets that you don't think you're needing in a position. Open up a home equity line of credit. Purchase a long-term care plan. That there are now some unlimited plans out there that if you're in a nursing home for 20 years, will continue to pay out. There are some of these programs out there. And if you're interested, reach out to us and we can discuss. And we'll together, through our collaborative process, figure out which one is best for you. Matt?
Ken, so if they want to reach out, if they want to get a copy of this article, they can't get this article out, in the general blog sphere, right? What should they do if they want this information or want to talk to us?
Email us at admin@mfplanners or call us at 888-339-0093.
Yeah, folks, just tell them, hey, you saw the long-term care YouTube video and you want the article, right? You want to talk to Matt or Ken, and we'll follow up and get something scheduled.
All right.
Thanks, Ken. Good
Of course.
stuff. Good stuff. Okay, so let's drill in on long-term care insurance. Now, what Ken was talking about, when you think about it, is the need of having a good plan. It isn't necessarily buying a bunch of insurance, but can insurance help? It absolutely can. Now, given some of the historic problems, it's understandable people are reluctant to look at it. You know, when it was first introduced, it was very limited, and the problem was too many insurance companies got involved in it too soon. Now, not to get too far down the road, but you know, one of the credentials I hold is chartered life underwriter, and one of the things you learn about how life insurance products are made is they look at things like how long do people typically keep the policy, right? How many claims do they end up paying? Well, when long-term care first came out, one of the issues was they used whole life as their template for it. And what they found was people actually keep their long-term care policies way longer than they keep their life insurance policies, which means more claims will pay out. Well, that's why you saw problems over the years with a lot of rate increases and things like that, because the insurance companies had to do those rate increases, otherwise they wouldn't be able to pay the claims. Now, I am boiling down a very complex issue into something pretty basic when I make that statement, but that's essentially what happened, right? In the late 90s, early 2000s, that's when you started seeing a lot of standardization. And some of the key things, dementia and Alzheimer's, Ken mentioned that, covered. No hospitalization requirement, no skilled nursing requirement. The terms are clarified. Like if you buy a life insurance policy with a long-term care rider, one of the companies we use has a 12-page document that says this is exactly how the long-term care rider works, right? And they make you sign that as an additional document to the application, right? All the underwriting is up front. So when you get underwritten at the beginning of the policy, you've got the policy. They cannot cancel your policy unless you stop paying for it. So they can't cancel it if something gets sick. And with traditional long-term care policies, which can still see rate increases, the rate increases are regulated. So for example, they have to raise the rates on an entire class of people, which could, you know, and I'm making this up to just make the point, could be people say ages 56 to 60, females, right? Those are the rates that have to go up, right? They can't cherry pick people in that group. They have to raise the whole group. Okay. So there's a lot of regulation that goes into this. And that in turn helps with the planning, right? Some of the approaches, and again, Ken addressed a lot of this, right? Some of the approaches that are out there are really just fantastic. This life insurance option that Ken briefly mentioned, the way those work, let's say you have a $500,000 life insurance policy and you have a long-term care rider on it. The way most companies do it is you can use that $500,000 of life insurance to pay for your long-term care needs. Now there's certain, you know, there's rules around how you take the money out and all that, but you've got that $500,000 there. The nice part about it is if you use life insurance for that, guess what? Life insurance rates are guaranteed. They can't go up. On top of that, if you die and never touch the long-term care side of it, well, now what happens? The whole thing pays out to your beneficiary as a tax-free death benefit. If I use part of it, the remainder pays out when I die. And if I use the whole thing for long-term care, great. I use the whole thing for long-term care. So you've got a lot of flexibility that suddenly comes into a plan when you add something like one of those life insurance policies with a long-term care rider. You can buy an annuity. You can create what I call a sinking fund, right? Shuttle some money into a specific account. That account, whether that's an annuity, whether that is just an investment account, that is the money you will use for long-term care. We have clients who do that too, right? Okay, the improved long-term care insurance. If you want to find out more about this, because you do get some federal tax breaks depending on your age and how much you're spending on the policy, give us a call. We'd be happy to take you through it. This is going to be your traditional long-term care policy. Okay, so just a couple things. It's a use it or lose it deal. If you never have a long-term care incident, you never have a long-term care incident. Okay, you never use the policy for what it was intended for. In that case, it'll work just like your auto or your homeowner's insurance, right? Hey, if you die and your house never burned down, right? You never put a claim in on your homeowner's policy, they don't give you any money back, right? They just say, thanks for being a client. That's it. They might not even say that, right? So that's the way traditional, this improved long-term care insurance works, right? It's use it or lose it. The other thing, rates can be increased. Remember what I said before about that, though. They can't just willy-nilly go about doing it. They've got to do it in, there's got to be classes, and most states will require that they have to submit it to the state insurance commissioner before they do it and get an approval on it. Okay. So I touched on the life insurance. The annuity options are really interesting because essentially you put money into an annuity and, and the numbers are different depending on which insurance company you go with, but you put money into an annuity and essentially they say, okay, you put $250,000 into this annuity. You now have $400,000 of long-term care benefits total. Just keep in mind, folks, that's not $250,000 plus $400,000 of long-term care benefits. $250,000 of the 400 is what you put into it. Okay. It can be a great tool though, because you don't, in those cases, you generally don't have to go through a lot of underwriting to get that approved. So if you've had some health issues and you've got some extra cash, that might be a good spot. Ken mentioned some of this in detail. It's in that piece he took you through. If you want a copy of that, because it does give you some nice primer points on this stuff. If you want that, again, just reach out to us. Let us know. It's admin@mfplanners.com or 888-339-0093. Tapping home equity. Hey, that's a loan. That's not income to you, right? Existing life insurance policies. I touched on if you have a long-term care rider, some insurance policies have what's called an accelerated death benefit option, where let's say you have cancer, right? You're very sick. They have a critical illness, and cancer is one of their critical illness options. So they give you some money at that point. Most policies will have a terminal illness benefit. So if you're within 3 or 6 months of passing away, you can access 75 or 80% of the policy, again, depending on the company. There are, and you probably see ads for this, there's something called viaticals. We don't do viatical settlements, but essentially what happens is an investment company will buy your insurance from you, give you a check, right? Now you've got cash. They own the policy. They get the death benefit when you die. So existing life insurance, that's why earlier in the presentation, I said, make sure you keep those policies as long as you can. You never know when they're going to come in handy. You never know. Roth IRAs, tax-free on the way out the door, right? Tax-free. Health savings accounts, tax-free on the way out the door, right? So those are 2 tax-free buckets you could take advantage of. Can you fund it? Absolutely, right? And hopefully that's what you're taking out of today's workshop or this recording is what we're looking at, folks, is putting together the right plan. When you put in tax planning, when you put in some insurance planning, when you put in some investment management, you put those 3 things together, you can come up with a very realistic and affordable plan that means that you're going to be able to protect your lifestyle, right? And live the life you want to live, regardless of what goes on from a long-term care standpoint. So some of the things you got to think about when you're building that plan: your age, are you married, your health, right down the line. But when you put it together, right? And check out our how tax planning changes through the 4 stages of retirement video, because that's got a little 3 to 5 minute segment in it on some of the tax advantages of doing long-term care planning. Basically, it gives you the opportunity to create a tax-free legacy, or maybe there's a partly taxable legacy once you've passed away. Because you did the long-term care planning, it gives you the flexibility to figure out, wait, what bucket of money should I be using to pay for this issue? So again, is long-term care somewhat confusing? Absolutely. Some key questions you want to ask yourself about this. Number 1, who's going to provide the care? Number 2, where do you want it? Remember, get it at home, right? You don't have to go to a nursing home. You don't have to. Number 3, how are you going to pay for it? So just 1 or 2 bullet points on each. Who's going to provide the care? Family? Folks, your family can help manage the care. Don't put it on them to actually provide the care, okay? I mentioned where do you want it? At home if at all possible, but there are other options. And then finally, how are you going to pay for the care? Well, the way you're going to pay for the care is through a good financial plan, which had a strong focus on long-term care planning. Could that be a blend of tax planning, income planning, and insurance planning to include long-term care? You bet it could. You bet it could. In most cases, that's the most efficient way to plan for it, is to have that comprehensive plan. And a couple last things, right? No 2 people are the same. This is not cookie cutter, right? Some people like insurance, some people don't. Some people want to use an investment account. Some people are really afraid of the market and just want to use CDs or something like that. Some people are really tax sensitive, right? I mean, everybody's different. You can get your care at home. And remember, the long-term care portion of this doesn't have to cover every last dime. What it needs to do is take enough of the bite out of that long-term care expense that it doesn't destroy you financially or destroy your spouse financially once you're gone. All right. If you celebrate Christmas, Merry Christmas. If you don't celebrate Christmas, have a wonderful holiday season doing whatever it is you're going to do. Like I said, we're recording this on December 21st of 2023. We like to put those date and time markers out there because it forces us to keep it fresh. We will be doing some more long-term care videos. We'll also be coming up with a couple of short long-term care pieces as well. But again, please feel free to reach out to us if you have any questions, especially if you want to get that piece Ken mentioned. You can see the contact information on the screen in front of you, admin@mfplanners.com, 888-339-0093. Check out our website too. You can always just fill out a form on our website and that'll forward to us, and then we can get a hold of you to have a conversation. But thanks again. I hope everybody on this call had a great 2023. If you're watching it in 2024, I hope you're having an awesome 2024 as well. So thanks again, everyone. And we will see you on our next video. Thanks again.